The banks are getting over on us right in front of our eyes. The three things that banks do that rip us off and how we can turn them ripping us off into an advantage that allows us to grow our finances. Now, you're thinking, what? How can we take advantage of the banks ripping us off? We're going to talk about that. We're going to show you example by example why it feels like the banks are ripping us off, but in all actuality, they're ripping us off more than what we think, and how we can grow our finances because of what they're doing.
And you just wanna get paid, tired of making no money mistakes, make a payment on your bills and you still late, yeah, painful profits to help you seek change, and you just wanna get paid, yeah, tired of making no money mistakes, make a payment on your bills and you still late, painful profits to help you seek change, yeah, cut the show and just listen, you wanna feel empowered by making money decisions,
Before we get started though, like, subscribe, share to our channel, and we're going to show you guys how the banks are ripping us off and how we can pull that band-aid off the rip off and get to the bag. Lego. Well, the first way the bank rips us off is because they do fractional banking. Now close your eyes and think about this for a second. How is it that I give a bank $100 and they on their balance sheet shows $100? But when they get my $100, they loan $90 of it. So think about it. Think about it. Somebody gives you money and you put that money in the bank. When you put that money in the bank, you give $90 of it away and you get paid by giving it away. But on your bank statement, it doesn't show you only have $10. It shows you have $100. How is that possible? I gave away $90. I'm getting paid for it, but it shows that I got $100 still. So with thin air, for every $100 we put into the bank, they created $90. That is what we call fractional banking. Don't take my word for it. Look at this article by CFI, which is a corporate think tank on how the banks are getting over. What is fractional banking? Fractional banking is a banking system that requires banks to hold only a portion of the money they deposited with their reserves. That means when I deposit money, they're going to hold a portion of it. So I'm giving you money and you don't even hold it. You don't put it in that big old vault. You give it to somebody else and make money. So you're making money on my money? Come on, banks, you're ripping us off. Take it a step further. For example, if a person deposits $1,000 in a bank account and the bank cannot lend out all the money, it is not required to keep all the deposits in the bank's cash vault. So I give you $1,000 and you're not required to keep my money? You can just lend it out to anybody and make money off of it and not me when it's my money? I'm mad, y'all. I'm mad. Instead, banks are required to keep 10% of the deposits, which is $100 in reserve. And they may lend out the other $900. So I give you $1,000, you keep 10. Sorry, I give you $1,000, you keep 100. The other $900 you lend out. But on the balance sheet, it shows that if it's $1,000, where my $900 go? You give it to somebody else and you're making interest off of it. How does that help me when I gave you that $1,000 in the get-go? Banks are ripping you off. The Federal Reserve sets the reserve requirement as one of the many tools to guide monetary policy. So the Fed is saying the banks can do it. Take it a step further. Let's say, for instance, I have $1 million. $1 million gets deposited into a bank. Do you think they're going to keep all $1 million in that vault? Of course not. They're going to loan out $900,000 of it. And you know what? From a loan standpoint, they got to pay 4.5%. This is from the Federal Reserve of New York. This is the Fed, you guys. 4.75%. Loan it out for 4.75%. Okay, they got to pay that. Loan it out to their own institution to invest it. Yes, right. Chinese wall, same institution, checking department, savings, loans, CDs, investment banking. Loan it out to my own institution with a Chinese wall, in the words of the Bible, the left hand don't know what the right hand's doing. Guess what happens? I loan it out and pay interest of, let's say, 5%. But let's say I make 10%, the market's up by 20% this year. Who's getting to the bag? Let's do the math here. 100 million, 10%, 1 year. $110 million. Now remember, they paid 5%. So they are paying from an interest standpoint, $5 million. I don't know about you guys, but if I'm able to take a person's money, have it look like I still have the money, loan out 90% of it to somebody else. Oh, that somebody else is my own company, different department, and then make, in this case, $5 million. How is that helping the American people? We are getting, every single one of us, we are getting ripped off by the banks. But we're going to go over how to profit from this, though, you guys. We're going to go over it. I just want to show you from an educational standpoint how we're getting ripped off. And even Investopedia said it, right? The Federal Reserve sets the interest rates. They're based on economic circumstances and how it decides it can best meet its dual mandate of maximum employment and price stability. But they're the one making the prices, not us. If a bank needs capital to fund loans, get this, you guys. If a bank needs capital to get loans, withdrawals, or pay their debts or meet obligations, it can borrow from other banks and then pay them interest. So you're tell me, a bank that took my money, my $1,000, they loaned out the $900, they got $100, I want my money, they can't give it back to me. That means they can do a loan. So in order for me to get my money back, you're not holding it and you're going to do a loan against another bank. And guess what? From a financial requirement standpoint, as long as they're a charter bank, it doesn't matter how good or how bad shape they are. So the Federal Reserve sometimes props up banks. They prop them up. Even though they're bad financially, they did bad loans, bad investments. They prop them up so that they can save themselves because of maximum employment and price stability. We can't do that in our household. We can't make bad financial decisions, and doesn't matter how jacked up our credit is or whatever decision we made at the time we thought was good is not good. We can't just get a loan and not have to worry about our credit score and just get it. No. Why can the banks? Because they are an institution that rips us off. Now again, there's ways around that, and we're going to talk about that, but that's number one. Number one, how the banks rip us off because of the Federal Reserve and fractional banking. So just remember, for every $100 you put in the bank, 10 stays in the bank, $90 they loan out, and they make money while you make pennies. 1, 2, now we're now 4%. Whoa, I'm getting 4% a year. They're getting 20. That's number one. Number two, the second reason why banks rip us off because of the SWIFT system. Any time that we do a transaction, we're charged a fractional fee, right? If you guys saw that movie Office Max, right? They found a way to kind of take all those fractional less than a penny and pocket them, and they got fired and everything went to kabooey. Well, the banks are doing that. They are making fractional fees each time we do a transaction. You don't believe me? Well, look. Now, this is from U.S. Bank. Not like, a shadow company, U.S. Bank, right? What does SWIFT stand for when I'm dealing with international wire transfers? International and domestic as well. SWIFT is an acronym for Society for Worldwide Interbank Financial Telecommunications. It may also be referred as BIC, Bank Identifier Code. To receive an international wire transfer, even a transaction in general, but this is international, the sender will need U.S. Bank SWIFT code, that's their SWIFT code. Also, we go to the ATM. Now, the ATM, how do you charge us when you all, as we have found out, you're all using SWIFT, you all have the same bank code. Why are you charging us an average of $4.77? Now, that's low. Now, If you need to take out money other places, like with Bank of America, you take it out of another Wells Fargo, they're going to charge you $20 to $25. They are ripping us off. Ripping us off. And now look, today it is the highest amount since bank rate began the survey in 1998. So they're actually increasing the prices, you guys. Wire transfer fees, anywhere between $10 to $50 depending on the wire, when they all use the same SWIFT. Foreign transaction fees, 1 to 3%. So that means I pay a wire transfer fee, and if it's foreign, I pay 1 to 3% transaction amount. And then, of course, the stop payment of $20 to $30. You press one button and you charge us $20 to $30. The banks are ripping us off. But a way that we can stop the foolishness, and this is a way, and it's called XRP. Now, since banks are inefficient by hand, the banks right now as we speak, are using Ripple, which is XRP, to do their internal transactions. When they do it, it frees up fraud. It makes things a lot smoother. Transactions are easier. Now, they still charge us fees. Think about that. They're saving money, paying less money to do things, and they're charging the same amount of money. That's called a higher profit margin. That's how they're making money, right? But as we can see, what is it? Ripple, as that pop-up came up, is a digital payment network. So it's a network. It's not like a coin that people think it is, like a cryptocurrency coin. It's actually a network. You're investing in a network, a system, and a protocol launched in 2012 by two individuals. The network uses XRP as a native cryptocurrency to enable fast. So not like a coin, but as a currency generating to enable fast, low-cost international money transfers and currency exchanges. Ripple focuses on serving banks and financial institutions by replacing traditional cross-border systems like SWIFT. This is the future, and banks are going to get more and more efficient. They're going to have less fees that they obtain. They're probably going to charge us higher fees or fees as they are, which means they make a higher profit margin. But they're using XRP in the Ripple network. XRP sets itself apart from other cryptocurrencies through its unique mechanics and business model. While most cryptos use mining to validate transactions, very important, XRPs were pre-mined. So we know how it works and we know how many coins are there. And how does the network work? The Ripple network processes transactions through the Ripple protocol algorithm. Yes, they've been using algorithms for a long time, which validates transactions by having design servers compare transaction records. So basically, you have a system that nobody can manipulate, a system of different servers and computers that you cannot manipulate that validates if a transaction is correct or not, but it's done within seconds. Not a person having to check something, double check something, no human error, is done in seconds. This approach allows XRP to process transactions in 3 to 5 seconds and handle up to 1,500 transactions per second. Not per minute, not per day, per second. 1,500 transactions. Faster than any traditional blockchain networks. My profiteers, how do we profit from banks ripping us off? We buy XRP coins. Now, you don't go YOLO. Do not put all your money in XRP. Don't put all your money in cryptocurrency. Check your risk tolerance as a certified financial planner. Each of our clients, depending on their risk, their age, their tolerance, we give them different parameters on what to do and how much to invest in crypto, how much in Bitcoin, how much in Ethereum, how much in XRP. But XRP is something that is going to be used more and more, adopted by more and more banks that are ripping us off as we speak. This is how we profit from banks ripping us off, buying XRP. It's the third way that banks rip us off. That third way is origination cost. When a bank creates a loan, they charge you a fee. That fee or that cost is called a origination cost. And look, different banks have different charges. But just in general, the origination fee, like I talked about, the one-time fee that covers processing the loan, even though now they're going to be using XRP that does it in seconds. That's why we buy XRP. This fee is a percentage of the loan, typically between 1 to 10%. $100,000 loan, you're going to charge me in between $1,000 to $10,000 just to shuffle paperwork around that XRP is going to do, and you're still going to charge us a fee for it? The lender usually deducts the fee from the loan amount at the time of funding. Still got to pay it though. Application fee, a flat charge just to get your John Hancock and do an application. And then the SBA, Small Business Administration, I'm SBA member myself, a flat charge that covers, the fee that lenders can pass on. So a lender, the bank, passes on to you, the borrower, you, for providing the guarantee. The fee applies to loans over $150,000 with terms of 1 year or less. Think about that for a second. A separate organization that has nothing to do with the bank is going to guarantee if I don't pay my bill back, they're going to cover it, and the bank still charges. If anything, the bank should be saying, hey, I'm going to decrease how much you're going to pay, because if you don't pay, this company that has nothing to do with us, doesn't cost us any money, they're going to cover your loan. Because you remember, when they loan out money, they're loaning out your money, not theirs. Because what we talked about before, for every $100 you put in, the bank, only $10 stays in the bank. The other $90 gets loaned out like this. The banks are ripping us off. How do we make sure the banks don't rip us off? First thing we do, cryptocurrency. Not all your money in cryptocurrency. And again, I'm a certified financial planner. I'm a stock person. We'll continue to invest in the stock market. That won't stop. But in this example, diversifying your portfolio. It's great to have stocks. It's great to have assets that are hard pause, like real estate. But having some cryptocurrency, Bitcoin, Ethereum, XRP, whatever your risk tolerance, and talk to your financial advisor about this as well before you make a decision. That's how we profit from the banks ripping us off. Number two, when it comes to those origination fees, make sure when you do a mortgage, it's done in the business name. If it's done in your name, might not be able to write that off. If it's through the business, we get more tax deductions as a business than as personal. So if we're buying something, make sure it's done in the business name, so the origination fee that they're going to charge you, the application fee they're going to charge you, the SBA if you're a small business like myself, that they're going to charge you, you're able to write it off. Now, when you write something off, you don't get it back dollar for dollar. A tax deduction is not a tax credit. A tax credit is when you get something dollar for dollar, right? I get a credit of $5,000. That means I get that $5,000 back on my taxes. A tax deduction or write-off is where I get some of it back based on my tax bracket. Hypothetically, I get a deduction of $10,000, right? I'm in a 25% tax bracket. Then that means 25% of 10,000, which is 2,500, I get to deduct. So still 7,500, that's taxable. I got to pay taxes on 7,500, but I'm not paying taxes on $10,000. It's a tax deduction. You don't get it all back, but something is better than nothing. Number three, invest. 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 I talked about crypto, but invest in the market, because historically, the market has averaged 8.5% a year. So, as the banks are making money from transaction fees, origination fees, they're taking our money, loaning it, and only putting a small amount of our money actually in the vault, and we're making pennies from an interest rate standpoint. How can we profit from them? Invest. Because when they loan out money to companies, what are companies doing? They're using that to grow their business. When they grow their business, what happens? Products are sold. When products are sold, the value of a stock goes up. So you indirectly are helping fund the stock market grow with your money, even though you're not getting paid for them lending out your money. So how do we make sure we're making money with our money that's being propped up by the stock market? We invest. The S&P 500 past 50 years, up over 8%. NASDAQ, past 40 years, up almost 10%. Now, historically does not mean future growth. And what happened in the past is not going to be what happened in the future. But invest in the market. Now, I did a webinar last week about the presidential election and how new President Trump grew the market by 16% the past 4 years when he was in office compared to the market being averaging 8.5%. Not political, just historical. So it is things out there that you can do from an investment standpoint in the market that might do better than the index, right? It's stocks we talked about. Click the link below if you want to get a copy of that webinar we did for our clients. We had over 300 people. I got about 1,000 clients with 300 people listened in. We talk about what stocks and what sector specifically we think is going to go because of the policies of newly President Trump, but invest. So yes, the banks are ripping us off, but the 3 ways that we profit from it: invest in the market. Number 2, XRP as one of our cryptocurrency investments. And number 3, if we do a loan, make sure it's done through our business. So all those fees that they charge us, we have ability to write it off and get back some of our tax money back in our pocket. So let me know what you guys think. A lot of good information. We're here to help. Like, share, subscribe to our channel as we continue to grow. We add value, and that value is helping you guys from an education standpoint. If you like what you hear, follow us. Click some of the links below with some of the coaching calls that we do to help you grow and scale your business. As always, love is love. Stay blessed, stay prayed up. Let's make some paper profits together, y'all. Peace.